Welcome to the Skilled MBA Finance Case Study series, where we explore real-world ventures that embody financial innovation, strategic thinking, and long-term value creation. In 2020, AMC Theatres, one of the largest cinema chains in the world, faced a crisis few could have imagined: zero revenue. As the COVID-19 pandemic shuttered theaters globally, AMC's very survival hung in the balance. With debt mounting and cash reserves dwindling, the company turned to unconventional tactics. This case explores AMC's bold financial engineering, raising capital through equity offerings at the height of the meme stock frenzy. Retail investors, galvanized by online communities, turned AMC into a symbol of market rebellion, providing a lifeline just as traditional avenues closed. But with opportunity came complexity. The company had to weigh its duty to long-term shareholders against short-term speculative interest. Ethical considerations emerged. Was it responsible to issue stock amid extreme volatility? Could AMC maintain credibility while navigating the chaos? This case provides deep insights into capital structure flexibility, investor psychology, and the evolving relationship between corporate finance and social media-driven markets. It reminds us that in times of disruption, survival may depend as much on adaptability and innovation as on balance sheet fundamentals. This case study, part of the Skilled MBA series by C. Fritz Foley and Donald Okofe, delves into AMC's financial crisis during the pandemic. It examines corporate finance, crisis management, governance ethics, and market behavior. Key questions include the extent of management's actions for survival and the ethical limits of financial engineering in crises. Before the pandemic, AMC was already financially vulnerable. High leverage from aggressive expansion increased susceptibility to market shocks. Operating over 1,000 theaters resulted in significant fixed costs. The rise of streaming services further eroded cinema attendance. Limited cash reserves left AMC with little buffer against unexpected expenses, setting the stage for a perfect storm. The COVID-19 pandemic forced AMC to shut down all theaters globally, resulting in a 100% revenue loss. Despite zero income, AMC faced a $120 million monthly cash burn due to ongoing fixed costs. With a pre-pandemic debt of $5.4 billion, the situation became unsustainable, leading to a 90% stock drop and imminent bankruptcy risk. By early 2020, AMC was on the brink of Chapter 11 bankruptcy. Analysts predicted this due to breached debt covenants and dwindling liquidity. CEO Adam Aron faced the daunting task of sustaining operations with no revenue while managing substantial debt obligations. AMC employed unconventional capital-raising strategies to navigate its financial crisis. At-the-market equity offerings allowed AMC to sell shares directly, leveraging price volatility. When common share issuance met resistance, preferred shares were issued. Debt restructuring involved negotiating with creditors to extend maturities, adjust covenants, and convert debt to equity, alleviating immediate financial pressure. Retail investors on platforms like Reddit's WallStreetBets drove AMC's stock price up over 3,000%, defying traditional analysis. Trading volumes hit hundreds of millions daily, showcasing retail engagement. Coordinated efforts countered institutional short positions, creating a short squeeze and providing AMC with unexpected liquidity, crucial during its financial crisis. The chart highlights a stark disconnect between AMC's stock price and its actual revenue during the pandemic and meme stock frenzy. Despite declining revenues, the stock price soared, challenging traditional market efficiency theories. This anomaly underscores the influence of social media-driven investor behavior over fundamental financial metrics. Management faces ethical dilemmas when issuing equity during inflated stock prices driven by social media, questioning the alignment with fundamental value. Utilizing technical charter provisions to issue preferred shares against shareholder votes raises governance concerns. Insider trading, where personal holdings are sold while raising public capital, challenges fiduciary duty ethics. Corporate governance faces intense scrutiny during crises. Board independence and oversight become crucial as companies navigate existential threats. Balancing stakeholder interests is vital when survival is at stake, demanding transparency in rapidly evolving situations. Fiduciary duties are reinterpreted when conventional options are exhausted, challenging traditional governance frameworks. Pre-pandemic, there were 314 million shares outstanding. By mid-2021, this number exceeded 500 million due to equity raises. Post-preferred conversion, shares could surpass 1 billion. These dilutive actions averted bankruptcy but significantly eroded original shareholder value, sparking debate on whether the solution was more damaging than the crisis itself. Meme stock dynamics reveal how social coordination can amplify market movements, with retail investors often displaying distinct risk preferences compared to institutions. Psychological factors can overshadow fundamental analysis, challenging traditional valuation models. Management responses include engaging retail investors through social media, adapting capital strategies to sentiment, leveraging popularity for partnerships, and balancing short-term gains with long-term credibility. Excessive leverage heightens risk during black swan events, necessitating rigorous stress testing of balance sheets. Companies should maintain diverse financing options such as debt, equity, and preferred shares to ensure flexibility. Governance challenges arise as stakeholders like creditors, shareholders, and employees have conflicting interests. Traditional finance theories often overlook the impact of social media-driven market irrationality. Management should assess AMC's fair value by analyzing fundamentals, market sentiment, and social media impact. Ethical considerations in capital raising include transparency and investor protection. Traditional bankruptcy theory may require updates to address social media's influence on investor behavior. AMC's case sets precedents for distressed companies in navigating market dynamics and stakeholder interests. Skilled MBA offers a wealth of resources for those seeking advanced business education. Their case studies provide deep insights into complex business scenarios, ideal for students and professionals aiming to enhance their understanding. Thank you for exploring this finance-driven case with Skilled MBA. For more practical insights and case study videos, mobile +91 87553 00795 email support@skilledmba.com, website https://skilledmba.com